So a trader, a day trader or a swing trader in FNO, that is future and options, has an option to take a trade either going long or going short. So we are gonna focus more on short today to have an understanding exactly how the market works in the short trade or how it works. Long simply means buying something that you are willing to buy, any instrument, any financial instrument that you are willing to buy and hold with an expectation to make a profit only when market goes up. But in short, you can buy an instrument with an expectation the market are going down and still making money out of it. So just to elaborate how it works, we are only focusing on shorts right now and how short works in a future market and an option market. This would be a quick view, then we will be jumping into short strangle. So what is short? First we will consider it in the future, in future market. So if we consider bank nifty at spot of, let's say, 35,500. So when we say market as is at 35,500, market can either go up or market can go down. So when you say market can go up and market can go down, a shorting opportunity could be a good way to make money even though market goes down, against the traditional belief that you only make money when something goes up or the price of something that you buy goes up. Shorting helps you to make money when price of something goes down. Here it is bank nifty. If bank nifty goes down, still we are gonna make good money in futures market. It is an opportunity to make money when market is going down. So how it works? So what will I do is I will short the bank nifty spot position of 35,500. So on 35,500 I would be taking a short. So if market goes down to, let's say, 35,400, I will be sitting on a profit of 100 points profit. And how it worked? Because we sold our position over here first and then bought it back when market came over here. So effectively the difference between it was 100 and you made a profit there. It is as simple as this. Something that is going down, you short it. There is an option over there. As you buy, you sell it, it comes down and you make a profit. So this is a good thing that we make a profit in by going short. But what happens if market goes up? So you shorted bank nifty at 35,500, and if market goes up, so market right now is at 35,600. So as you are sitting in short position or you have taken a short position, you would be making a loss of 100 rupees. This is the loss that incurred because you sold first and then bought. So in shorting, you sell your financial instrument first, then you buy it again, and the difference is either your profit or your loss. So financial instrument or the trade we are taking in is in bank nifty. So bank nifty from 35,500, we sold it first, the market went up, we bought it again to cover up our losses. The losses incurred over here is 100, and this is the absolute loss when you exit the trade. The losses would be 100 plus whatever your charges and taxes are. This is loss, right? Loss. But profit would be, as we seen before, 100 100 minus charges minus taxes. So if you consider this format, so profit could be 100 minus charges minus taxes. Losses would be 100 points loss plus charges plus taxes. All this will be considered as a negative to your P&L. This is the basics of doing trade in futures in short position, or taking a shorting, generally known as shorting. Now if we consider same thing in options, there are two parts, call and put. So call is something that you buy when market goes up, right? You make a profit when market goes up, or the price or the premium of call goes up when market goes up, and premium of call decreases when market goes down. Premium decreases if market goes down. When you buy when market goes up, premium increases. So you would be making money when market is going up by buying the call. But in put, I will just give a basic about put also. Put premium changes according to the nature of it, which is exactly opposite to call. That is, you buy when market is going down, and the premium goes up, and when market is coming down, coming up, going up, the premium of put goes down. The put goes down when market goes up, put goes up when market is coming down, right? So this is the basic thing that we need to understand. Now we will go into the short aspect of it. So while we consider shorting call, we expect market to go down. So we expect market to go down. So the premium, let's say the premium of call is 100 and market bank nifty is at 35,500. If bank nifty goes 35,000, the call price will go down. Call price will go down, right? If call price goes down, you will make a loss if you have bought it, right? If you buy, market goes down, your value goes down. So call would be available here, let's say 50 rupees. So you will make a loss of 50 rupees. But if you short it, if I short the call at 100 and market goes down, market goes down, the value of the call will go to 50, but as we have sold it at 100, so 100 we have sold it, the premium of the call was 100, we sold it, and when it become 50 we bought it, we made a profit of 50. This is the absolute profit of 50 in premium. So even though market went down, we shorted call, we short it at 100 and market came down, it became 50, we still made a profit of 50 points. This is the magic of shorting. So this short is similarly working in put. If you short put, the only way you make money when you short put is when the market goes up. Market should go up, you make money in your short position. Short position gives you positive return, right? Just for example, bank nifty at 35,500 goes up to 36,000. So if you short put, then if we consider the premium to be 100, it could jump 50 points to make it 150. If you consider put as short, and if market goes up and the premium is 100 and market went up, let's say the premium goes to 50, as you have sold over here and bought again here, your profit would be 50 points because you are sitting in short. As you sit in short, market value can decrease but you will make profit into it. So this is the basic thing that we are considering. So when you consider short, consider the opposite nature that needs to be there while buying call and put. You buy put and expect market to go down, but when you do put short, you expect market to go up. When you do put short, you expect market to go up, right? So this is how we make money. One more important concept over here we need to understand is that short seller of put or call has limited profit and theoretically unlimited loss. This is because a premium of 100 that is shorted can go to 0 and you can make maximum profit of 100 rupees. Maximum profit of 100 rupees. But if 100 rupees that you have shorted, it can go 1000 rupees because market can go infinitely on the up direction, but not possible in the short position or in the down direction. So if you sell at 100, it could even go to 1000. So it is very important to keep an eye to your short position. More important to keep your eye on short position than your long position. So this is the basics that I wanted to give you. Now we will consider short strangle. It is a very easy concept once understood. If you do not understand it in the first go, keep an eye on what I am saying by watching it again and again. So, in short strangle, we take a short position of call and a short position of put, right? Even though it is opposite to each other, we are taking this trade because we are creating a zone of profit. So this profit zone exactly represents in the way you can see in my shorts. If you see the payoff graph, you will understand why I only focus on the nature of the price movement and what is the zone that it is moving in. In the same way, in short straddle is it is defined in the zone that it is going to be profitable. So right now what I am gonna do is make you understand what is a payoff graph. So let's say Bank Nifty right now it is working at 35,500. So the spot is at 35,500. 35,500, right? So what we do in short triangle is that we go out of the money or away from 35,500. Here you can say 35,000 over here and 36,000 here. So what we do is we go away from it like this and we short here. So we short call on the upper side, that is out of the money, and short put on the lower side. So basically if we consider 100 rupees premium here, 100 rupees premium here of call and of put, and we are sitting in short positions in both the sides, we are creating a zone of profit. Generally this could be very easily defined if you consider the expiry of option as only one. That means in the same expiry both are trading. Right now we are only considering one option expiry for put and call. There are multiple way how you make a short strangle, but this is gonna be the basic one. So I'm gonna teach you with an expiry of only same week, same month, or next week, but same expiry. So right now we have considered this. So what happens, market is running over here 35,500, we shorted here and here at 36,000 and 35,000, and premium is 100. So the payoff chart is kind of like this. So if market is between this zone, this is our profitable zone, the highlighted part is our profitable zone. If market is between this zone, we are gonna make profit. So if market ends at over here only, we are gonna make 100 points from put side, 100 points from call side, because we are sitting in short position, right? If it exactly ends up here, we are gonna make 100 points, that gives us a profit of 200 points, and it is the absolute profit you will make, right? And even though it expire, if the option expiry comes over here, you're gonna make 200 points. That is the beauty of it. Anywhere in this zone, everywhere it is going to be profitability 200 points when option expiry happens at 3:30 p.m. that is Thursday. So this is the beauty of short strangle. So even though this is a basic thing that we are learning right now, we will see what adjustment we will need to be making in order to get things right. So what happens if there is no option expiry and market moves along over here? So at that point of time, let's consider this 36,000 and this as 35,000 and 35,000, the midpoint. If the spot is over here, the price of call short will increase. So 100 premium that we shorted before will go to 200, 300 or whatever it may be, and the put side short, which was 100, the price of it will go to, let's say, 50. So you will be making profit of 50 here and you will be making a loss of 100 here. So this will create a problem to you, right? So if we consider this situation, it is not good for us. We will be coming out with a 50 rupees loss here. To avoid this, we do some adjustment, right? Now we will look at short strangle adjustment. So while doing adjustment, here are some consideration. If market is going up, you cut off your position after it moves 200 points on either direction, or if we consider only going up, you cut off your short position, because once it goes from 100 to 130 or 140, you cut off your position here and let this side position, that is put short, open. That is, you continue to let this work. So this 100 would go to, let's say, 70. We keep this position and we expect market to go up, let's say 300 points up right now. So while it is 300 points up, this is when it is up 200 points. This could be 60 points when market went 300 points up. So if you cut your position over here, so you would have incurred 30 points loss over here, but you would have made 40 points here in the short position. When market was here, you cut off your position because it went from 100 to 130, and you incur 30 points loss. But in put short, you made it a profit when it went to 300 points. When it was away 200 points on the upper side, you were making profit of 30, but when it went 300 points up, you made a profit of 40 points. So 40 points profit and 30 points negative, you are still making profit of 10 points, right? This is the basic thing. This is the one of the basic adjustment that you do. But here a problem is that if market turns back again and comes over here, there could be a problem that the short put will go from 60 to 70, and this might go back from 130 to 110. But if you have cut your position here, you had defined that you have made loss of 30, but here when you were making profit of 40 points but market went down, that is back to 200 points, you would be making 70 points. You'll be looking at the screen that put is costing 70 right now. So you would be making 30%, 30 points profit. So when market was at 200, when it came back to this point, so your profit is 30, your loss is 30, so you are on no loss no profit, right? So this is one of the basic adjustment, but the problem is that when it comes back, it is biting you. So what I generally do is, if I see market coming down, and if I see this is my important pivot point, I just cut off one of the position. Since it is coming down, I will remove my short position and keep a threshold that when it comes back again, I will be removing my short call short position, as there will be theta decay. As there will be theta decay, the call would be losing some more value. For you to understand this theta, I will be posting, or you could search for option Greeks by Pro Trading Zone. You can search this on YouTube, you will find a video. I haven't posted it yet, but in 1 or 2 days I would be posting it, and you can understand what exactly I mean by theta decay. So there would be more value that would have come down. So when it goes down and come back again, we have seen there is 30 point loss over here and profit over here, and it was giving you 0. Just because of theta decay, there would be extra profit over here. Let's say 35 points profit and 30 points loss. So you would be sitting in profit of 5, right? So the simplest thing that I have explained over here is that there is a Greek option Greek known as theta decay. When we expect market to come down, we exited our put short position, and when it started to going up back on the same way where we exited our put, we are going to exit our call also. So this will give us profit if there is good theta decay. If not, we would be exiting on our break even. So this is the one of the most basic way how you adjust your strangle. You will require no extra money, you will require no delta adjustment, no theta consideration, nothing. You will see the price on the your screen, and you will decide what to do. I will give you a point to consider every time you take a trade. A small profit is good, a small loss is good, but a big loss is bad. So if you see yourself going out and seeing a bad position for yourself and you are just holding it, you are just making problems for yourself and making your losses bigger. So if you want to see what are these pivot points, you can see my pivot point video, pivot points by Pro Trading Zone. This video will also be uploaded in next few days, so you can use this point also. So I will just sum up everything that we have learned. So we are considering call short and put short at 35,500. Both are having 100% 100 points as a premium. We are sitting on put short and call short. So as market expires here or is in between this, that is when option expiry at 10:30 p.m., that is Thursday, you would be making 200 points profit straightforward, but this is not recommended that you sit till 3:30. If you see good profit in your trade, let's say wherever the market is, but if you see profit before expiry also, you can exit that position. This is your profit zone, right? And then we have seen what happens if market goes up. The put will be for 50 points and call could go to 200 points when it touches over here. This is the point 36,000 market spot has reached over here, and at 36,000 the price of call went to 200 and the put side went 50. So you made a loss of 50 point, and here came the need of adjustment. So here we started with short strangle adjustments, and we have considered it to go 200 points away. As it went 200 point away, we are making 70, we were seeing 70 points over here in put side, but 130 points in call side. So we exited our trade in call side and we booked our profit in put side. So we ended up with break even at 0 point. And this could be seen more prominently when you consider the pivot points. Pivot point is a point where you consider that put value will increase exponentially. So this put value, whenever it touches over here, you exit it and let your call position run. Because market is coming, we exited put short and let call run. If market go up again, we would be exiting our call short position on the 7th pivot point. So as there is theta decay, you could see a extra point where you are earning as profit in your call position. So this is call, this is put. So call gave you 35 points and put gave you 30 points. You exited with 5 points of profit. This is one of the first basic adjustment you want to learn. This is the foundation for everything that will come in this channel later on. This is a basic adjustment, but you could have good amount of understanding about this first and then move along to more complex patterns and complex way to do adjustment. This is something I post on my shorts in my live analysis and taking trades, and this is something that I follow. This doesn't mean that you will make profit every time, but when you will make a loss, you will make a small loss. When you will make a profit, you will make a small profit. So generally we make a profit approximately, I consider while trading is 0.5 to 0.8% a day, a good profit that I made for the day. When I say 0.8%, that is on the portfolio. So let's say if you have 2 lakh rupees as in your portfolio, and this trading requires minimum 2 lakh rupees. For short strangle to work in your favor, you require 2 lakh rupees. 2 lakh rupees with you in your account so that everything is managed into it. It will typically take 1.5 to 1.7 lakh rupees, but you have to keep 30k as buffer, as margin, or you can say. This is for one lot. And when I say 0.5 to 0.8%, this becomes 1000 to 1600 rupees every trading session. This is for one lot. One lot we expect this to be a profit, and we do not take much trade each day. If we find there is a good setup, we might take multiple trades. But when I say there should be only one trade, when you are a beginner in this trading setup or you're a beginner in option selling, you should only take one trade a day, and if you incur a loss in it, you should not take another trade over there. So this is the basic. If you didn't understand anything, please go and watch the video again. I started from very basic and then I explained you short, strangle with very basic adjustments or very basic trades that you need to take. This is the basic one. So follow it first and later we will do more complex one. If you have any questions regarding this, comment in the comment section. I will be happy to answer it. And mind you, this is not 100% probability profit making strategy. It has its ups and downs, but this is the beginning where you will be in option selling and making good money. Okay. Please like, share, subscribe, and if you have any other query, please let me know. Thank you.